So you want to know, how does economic uncertainty and more importantly, the media addressing it impact the housing market? Well, in this month's National Housing Market Update, that's exactly what we're going to address. And as we look at any level of economic uncertainty and the impact that it has on the housing market, we're also going to cover the last 6 droughts and or impacts that we've seen and what did they really lead to, because as many people know, that's the important part, is not necessarily what happens, but where will it lead you to in your decision making when it comes to buying, selling, or investing in real estate. So let's dive right into this month's first to know National Housing Market Update. And as we look at a lot of feedback from different chief economists of different companies, is that the reason why we're talking about this is because if the media is discussing it, it's more important for us to address it locally and nationally, because we know the media does more to terrify than clarify, and the headlines do more to harm than help. So what is a reality is the risks are increasingly high that we're going into a recession. We're not there yet, and maybe this thing gets turned around, but that's increasingly becoming hard to do with each passing week. And so what do they mean by that? Well, as you look at inflation remains elevated, and remember, this is just overall the Federal Reserve target rate of getting back to 2%, where we were in 2020, 2021, and it's becoming increasingly difficult to get there. So that's one of the indicators that people are continuing to talk about, is not seeing an improvement in inflation. I think the worst is yet to come when it comes to tariff-driven inflation. I think over the next few months, we're going to see more and more evidence of the tariffs showing up in inflation. This is Michael Strain, Director of Economic Policy Studies for the American Enterprise Institute. And so again, as we start looking at some transitions from where to where we're going, is some other people think that it's not necessarily going to get any easier. As you look at unemployment still holding steady, meaning the unemployment rate increased to 4.2% in July. Again, this is a number that we were trying to get, lower than 4%. And as you know, prior to COVID, those numbers were increasingly lower. And as we saw from May of 2020 till now, not really any level of unemployment decreasing, and that continued to basically hold steady. Job growth is stalling out as you look at the number of jobs added by month, going back from January 21 all the way to July of 25. Again, our number of job growth is stalling out. And then why is this the most important to discuss those? Because as you know, what we always talk about is what matters to you. And as we look at keeping current matters, not just for you and your decision making, it's very important for us to make sure that you get accurate information, not positive, not negative. And so people are worried about an upcoming recession. As you can see, nearly 2 in 3 Americans think a recession is coming. 74% of Americans admit that world news and or current events affect their financial decisions. So the goal is to help you understand that while we can't control any headlines and or concerns, what we can do is always keep you abreast on how's that going to impact the housing market. So an economic dip brings opportunity, but you have to be careful. Just remember, every single changing market brings opportunity specific to housing because it's such a large financial investment and the information available is very limited to you unless you follow somebody like us and or you have access to top economists and this information. But unfortunately for most real estate professionals, where yes, this year 60% of them haven't even closed a home, is unfortunately there is a lack of professional expertise, and that is what's difficult for people to make a decision without any level of understanding. So Daryl Fairweather, Chief Economist in Redfin, said this well: Fed is in a tough spot. Some argue that with a weakening labor market, it's time to bring rates down. Others points to rising inflation, say a rate cut is misguided. The most likely scenario, the Fed will cut rates to stabilize the labor market, viewing any inflation from tariffs as temporary. But if that assumption proves wrong, we could be looking at rate hikes again in 2026. So just remember, interest rates lower demand. However, supply is a key indicator to whether it can match that demand, and that's what usually leads to whether or not home prices are going to go up, stay flat, or come down. And so as you can see, a stalling job market makes a cut likely. And as you look at what a lot of people misunderstand, those when you hear this news that the Fed funds are dropping rates, is that's not necessarily indicative of what will happen to mortgage rates. You see, people are expecting a rate cut in September. The mortgage-based industry already lowered rates as you started seeing a lot of these changes at the beginning of this month. They already changed the interest rate for mortgages with the prediction that the Fed was going to lower it. And as you start looking at why do these things then not align, is because they're two different industries and what they're trying to impact. However, each industry impacts one another. As we know, what happens with housing definitely impacts the rest of the job market. So today's mortgage rates already have the anticipated December Fed rate cut priced in. This means that when the Fed officially announces the cut, we shouldn't expect a significant corresponding drop in mortgage rates. So as we were just sharing, do not expect when you hear the news to actually see a rate change. It's already happened, which is why this type of information and meeting with local professionals is so important, so you can navigate this information and come up with a strategy if one of your goals is to buy, sell, or invest in real estate. As you can see here, mortgage rates declined after the weak jobs report. This was all the way back in August. And as you can see now, at the beginning of September, we already started to see the rates cut in mortgage. Expect 2 federal fund rates cuts this year, cut probably as of 9/2. So again, these are just the percentages of how many cuts do we think we'll see and where can that really lead to. Now, again, I almost want to dismiss these slides, but it's important for you to understand them because you're hearing this news. But what does it really mean is, well, where are the rate projections leading to? That's what most people are trying to decide is, should I get out there and buy in today's market or should I wait for a future market? And that waiting has a massive opportunity cost, especially if you're waiting for rates to drop immensely. So you can kind of see here, Q3 of 2025, the average was about 6.68%. Now, what's interesting is some of our mortgage partners are pricing out loans as low as 6.1% right now. So again, these are most likely bullish projections. Nobody wants to be wrong. But again, at 6.4 at the end of next year, and remember, this could be with some rate increases throughout. So the important part is continuing to look at how your strategy aligns with when you want to buy, sell, or invest, and not just wait on interest rates. Because remember, interest rates lead to demand. If you wait for everybody else to get in the market, it may lead to the wrong opportunity for your specific situation, which is why there are other negotiations and programs available to lower your interest rate for time periods. So then that way you could take advantage of today's market and utilize a lower interest rate for a little while. Then you can refinance when these interest rates finally hit a potential low. So while there will be a significant regional variation, the underlying fundamental conditions of the national housing market support a natural moderation of home prices rather than a sharp decline. You see, for most people, the only concern they have is home values dipping or crashing. But as you can see, listing prices have already flattened. What we mean by that is they started to decrease sometime in about August of last year. And then as we're starting to look at January, February, and March, yes, the listing prices have gone up a little bit. Remember, median listing price is not necessarily an indicator of whether home value is going out. That's usually months of inventory and or supply available based on the amount of demand. But median prices are a good additional indicator to just follow trends. And so as you can see, listing prices have already flattened. As you can see, really for the last 2 years, that's kind of been the case. But you can see just a very normal seasonality of median list price staying roughly the same. And that's why there's very little projection of home prices decreasing, because as we've seen 2 years, all right, of this flattening, we're almost through what some might consider the drought. And as you can also see here, we're also, as you look at year over year change in appreciation. So this would be the actual home values, those that you own, not just that those that come to the market. Is we saw a rapid incline, obviously, throughout, the periods of COVID and the pandemic. And then we started to see these last 2 years, a slow decline. But remember, it was a slow decline in the rate of which home values were still going up. The housing market has cooled modestly in 2025, but the extent and persistence of rebalancing really varies across the country and regionally. Home buyers and sellers are likely to experience a very different market. You see, this is the challenge, and this is why it's so important to see your local data, which is why we put out the First to Know Denver Metro local data. So then that way you have available information to look at the key indicator, which is months of inventory. Remember, anything 4 months or less is a seller's market, meaning that there's a high probability that home values will keep rising. The less amount of months, getting back to 2-ish, which again, here in Denver Metro, we're already back down to only 3.5 months, which is why most people are expecting home prices to rise again. And across the nation, you're seeing the same. And you can see, more importantly, home prices rose 2.94% Q2 of 2025, meaning that the year over year of averaging about 3%, which is just traditionally 30, 40 years, what we tend to see is that the mountain range is at 1.33, the west, north, central 3.75, but you can see mid-Atlantic, the northeast has already recovered faster, the west slower. But that is from the last year. Now you have to look at what has been happening over the last 90 days to 6 months to have a good indicator of what's going to happen in the future. And here in Colorado, as you can see, it's close to that west, north, central, or that mid-central mountain range, is we're seeing these home values appreciate at higher rate because inventory is declining fast. The reason why we discuss this is that for the last 2 years, we've been in a little bit of a drought. And we could just say a drought can be caused for a couple reasons. What was the rate of home price appreciation, which was so extremely high last 5 years, almost 55%. So when you look at the last 2 years, some markets being flat, some markets being down 2%, some only being up 3%, you can see this number is very modest. Is it really a drought, or was it a rebalancing of what's required because the rate of home prices going up was too great? So just to give a timeline of different major slowdowns in the housing market, you could see the early 1980 recession, the 2008 great financial crisis. Remember, that wasn't really a housing crisis, it was a financial crisis of bad loans, COVID, and then ultimately the 2022 to present slowdown, which was high rates slowed demand, is that the median sales price of homes sold over the last 50 years, you can see in every one of those droughts, though, there's been a level of rebound to where overall median sales price and or home values continue to climb. And so if you really look at the end of this graph, you can see that just as we noticed, over the last 2 years, is that most of these markets don't last much longer of a drought than 2 to 3 years, which is why there's a high probability that many people are expecting going into, and you can also see here that this isn't the first, slowdown that we've experienced. Sales always come back. And what they mean by that is the home sales. So you can see 2022 to present, the peak sales rate during that time frame was 6.4 million homes sold. The lowest we got to was 3.9, which was that of 2024. And so for many people, you can see home sales drop. This is not the price, it's the percentage of people purchasing, buying, selling, or investing. And so you can see the time to recovery, 3 years, 4 years, like we were talking about, 8 months during COVID. And this one is probably right between those 2 to 3 years, which is why many people are predicting that we're going to start seeing again more home sales. Remember, this is just the amount of transactions, not the value of the homes. And you can see most likely the home price trend is what's most important. In the early 80s, home prices started to rise during that time period. As you can see, the 2008 crisis is the one that most people tend to hold on to because that's the one that hurt home prices the most. We know what happened during COVID with home prices, but that was because there was very little inventory. There's no supply. So no matter what, even if there's limited demand, if supply is even less, you can see where home price appreciation will rise. And that's where we're kind of getting to right now. 2025 was a really good balancing year because we saw inventory rise, we saw active listings sit, and many of you took advantage of great opportunity in purchasing homes, getting a great deal, but also not feeling like there's only a limited amount of homes to purchase. Because as much as we share data, we also know, and when we help individuals buy or invest, more buy and sell, not necessarily invest, is there is a extreme emotional factor of the financial impact being limited to the emotional impact being greater in where you choose to live the next 5, 7, 10, 15 years. Now, U.S. home price expectations, this is the key. Well, what's going to happen with home prices? And as you can see in Q2 of 2025 all the way through Q4 of 2029 is that we're continuing to see that rate of appreciation in the, guess what, the most pessimist view of about 3-ish%, 2.5% a year. But remember, in some of these markets where a home is $1 million, that's still $25,000 every single year, you know what I mean, at the rate that a home is appreciating, okay? At a $500,000 home, it's still the same thing. Each year, you're losing $10,000 to $15,000 in the overall value of a home that you could have purchased to what you purchase now. And that's not even taking into account all of the benefits with tax deductions as well as equity gain by, again, paying down your own mortgage versus paying somebody else's rent. But as you start looking at bullish numbers of 27%, again, that would sit us, roughly in about 8%, appreciation, 7% appreciation, which those numbers are scary for an affordability. And it is a potential that home prices could go up that much if, again, there's not a lot of inventory. And so for most people, the goal or the takeaway in understanding this is that home prices are not coming down. So your wait should be strategic. Your wait should not be for prices to drop. And as you can see here, the expectations of 2026, they're thinking another 500,000 people getting involved, buy, sell, or investing, transacting in real estate, which that's almost about, about a 16% increase, which is great growth. As you saw all those other years, we saw decreases of upwards to 50 to 30% less home sales going through these droughts. And that's why most people are believing this drought is over. And as my great mentor, Tom Ferry, shares, every drought ends in recovery if we analyze the last 60 years. So from us to you, we hope that each and every one of these months, when it comes to the national housing market update, helps you better understand why is the media talking about what it's talking about, you understanding the most important factors for most people that we look at when it comes to buying, selling is when should I do it? And then what is a predictability around the market? So then that way, if I do have the option to wait a little while, does that make sense? And for purchasing, that has not made sense really for anybody because the market conditions continue to align with not a substantial rate drop and that of home prices continue to rise. And even if that's at a small amount, it still makes sense to take advantage of the current market conditions if you want to purchase a home. If selling a home, well, guess what? A balanced market makes it much easier if you need to sell to purchase versus where we were during the pandemic. And so each and every person, our goal is to continue to help you better understand what's happening in the market so you and your family can have a better time frame of knowing it's probably time to start researching more. And in that, reaching out to us, conduct a strategy session, learn a little bit more about your family, what you guys are looking to have happen, not necessarily in the nation, but more important in your hyper local market and getting connected with the top 1% of real estate professionals who this is what they do for a living and are more than grateful to be able to spend time educating you and then eventually creating an engaging experience where you guys have fun and something as rewarding as where you get to live, what you get to do, where you live. And for me, that's raising my kids and being an active part of our community. So thank you very much for your time. And as we continue to move forward, you will see that you have this month's First to Know local market for those in the Denver metro. And again, in any community, we can get you connected with a hyper local market level of expertise so you can better decide what should you be doing when it comes to buy, sell, or investing in real estate.